All right, guys, welcome back. In this video, we're going to talk about healthcare and retirement. Now, this might not seem like a very exciting topic to you, and truth be told, it's not very exciting, but it is incredibly important. More retirement plans blow up because of unaccounted for healthcare costs than almost any other reason, okay? It's a major, major factor. So we're going to talk through it and also talk through how you can be prepared and can plan ahead for it so it doesn't derail your plan. So healthcare costs in retirement are a big deal. It is a large expense over time. On average, there's a lot of studies out there, so there's a little bit of a different number out there for everybody. But on average, per couple, you're looking at about $400,000 that you're going to spend on healthcare during the retirement years. That does not include long-term care costs. So if you end up going into like a care facility, like a full-time care facility, that is an additional cost, and those are extremely expensive. They can be tens of thousands of dollars per year. And so it's a big deal. Again, they start on average around 400,000. We know how quickly healthcare costs are rising. The rate of inflation in healthcare is staggering. And so by the time we get to retirement, you can just kind of do the math and realize, hey, it's going to be a big bill, whatever it is. So let's talk about what the solutions are. So there is kind of like receiving income during retirement. There's Social Security. That's the safety net the government has. Medicare is the same safety net in terms of healthcare. Okay. So Medicare is essentially government provided healthcare, health insurance. You are eligible at 65 to begin claiming it. Now, Medicare alone is maybe not sufficient. So they have a number of supplement plans that you can add on that you would pay the premiums for that might give you better coverage and things like that. But Medicare is kind of the basic government provided healthcare solution starting at age 65. That's part of the payroll taxes, the FICA, it's Social Security and Medicare tax. So you're paying into this system and you will get a benefit at the end. Now, they have supplemental plans and things like that that you add on that you end up paying for. That being said, it doesn't cover all costs, and you still have you can have some significant out-of-pocket costs beyond what they cover, okay? On top of that, if you're planning to retire early, or at least before age 65, then there is going to be a gap in your healthcare coverage. And you got to figure out what that gap is, okay? Do you go get, if you retire or leave your job, do you enroll in COBRA, which is basically extending that insurance and keeping that around? It can be really expensive, but maybe that's your healthcare solution to bridge the gap between retirement and age 65 when Medicare kicks in. Maybe you just go out to the marketplace and you shop your own private plan. Maybe there's a number of different healthcare sharing groups that are out there. They're not insurance, but health sharing groups where maybe the costs are lower, but maybe they don't have all the coverage that an insurance plan would, okay? So you've got to think through that and understand that healthcare can be kind of expensive. If you're used to the employer picking up the tab for you, you might be in for a nasty shock. Healthcare premiums can be pretty high if you just get your private coverage. So those are some things you got to plan for. You have to plan for that extra cost, right? It could be $10,000, $12,000 more per year, depending on your income. It might be very little. It might be a lot. Just a lot depends on your income. But that's just an extra cost that you need to plan for, okay? So one way that is a fantastic way to plan to cover these costs is through an HSA, a health savings account. So I'm going to talk about that here now, and you can go and look and see if you're eligible, okay? You have to be enrolled in eligible high deductible health plan. What that means is you're electing a health insurance coverage. We'll talk again about a lot of this stuff in the insurance module, but essentially what it means is you are electing to pay lower premiums in this plan, so lower monthly premiums, because you're willing to pay a higher deductible in case something happens. That might be $8,000 out of pocket before health insurance kicks in to pay for costs, okay? So there are other plans, obviously, where your premium per month isn't much higher, but your deductible is lower, right? That's how insurance works. Those are some of the levers you can use. So you have to be on an eligible high deductible health plan. And essentially, you can take the savings that you would put towards a premium and you can actually just put that right into an HSA. Your employer may actually provide this. So if you're on the right health plan, they may provide an HSA. Some companies will even match your contribution. They might put in a set amount per year, and then you just have to, you top it off to max it out. So look at your employer benefits, check out, see what kind of plan you're on, and if you're eligible for an HSA. Now, if you're on an individual plan, you can contribute up to $3,600 per year. This is a 2022 number, so this number can change. It's subject to change each year. So up to $3,600. If you're on a family plan, it's up to $7,300. The great thing about the HSA is it's a triple tax threat. Okay, there's 3 tax benefits, and these are important to understand. When you contribute to an HSA, that is a tax deductible contribution. Okay, it's essentially a pre-tax. It's kind of like a traditional IRA. You put money in, it goes pre-tax, you get a deduction from your income. Okay, it grows tax deferred, but in retirement or when you're eligible, you can actually withdraw this money, and if you use it for qualified healthcare expenses, then the money you draw out is also tax-free. Okay, so it's like a mix of the best of both worlds out of a traditional IRA and a Roth IRA. You put them together, and it's like a super account for healthcare costs. Okay, so tax deductible going in, so you get a deduction this year for your contribution. It grows tax deferred, so you're not taxed year over year on gains, dividends, interest. And when you pull money out for eligible healthcare expenses, then what you pull out is tax-free. That is huge. That's a really, really big deal. And the nice thing is you can actually invest this balance. Okay, you can invest it in, wherever you have it. I had an HSA at Fidelity. They would contribute some, I would contribute other money, and I could actually go and invest that in the market by mutual funds or stocks or ETFs or whatever. Okay, so it could grow instead of just being cash. Now, you can pull money out of the HSA at any point. Okay, you don't have to wait till age 59 and a half or anything like that. If you pull out money, if you put in, make a contribution today and tomorrow you have an expense and you pull money out, it's completely tax-free. Okay, you're covering that expense with tax-free dollars. So you could use it to fund current expenses, or the strategy that I prefer is start contributing, and if your cash flow allows for it, just pay for healthcare costs now, like in these intervening years here, pay for them out of cash flow and let the money in your HSA sit there and grow and grow and grow tax-free for the future when your healthcare costs are going to be big and you might not have the income to cover it. We're going to look at an example here in just a second that I set up for Jim and Pam so you can see what that might look like, okay? But one other really important point. You might say, hey, well, what if I have a ton in my HSA, but I don't need it for healthcare expenses and I just want to pull the money out? If you pull the money out for non-healthcare expenses, then you will be charged tax and a penalty. So you don't want to do that. But that ends at age 65. At age 65, you can pull money out of an HSA for any reason and not pay a penalty. So if you pull it out for non-healthcare expenses, then you only pay the tax, okay, on what you pull out. Kind of like a traditional IRA. It essentially becomes a traditional IRA, but if you use it for tax benefit for healthcare costs, then it's tax-free, okay? So at age 65, there's no longer a penalty. You can pull the money out for any reason. If you pull it out for a qualified healthcare expense, then it's tax-free. If you pull it out for another reason, then it is added as taxable income. You pay tax just like a traditional IRA would. So let's just look and see what would happen to Jim and Pam if they did this. So we're going to go to the report section again. This is the best place to look at it. And we're going to go to the balance sheet report. And here, again, it lists all of our current assets, right? They've got their health savings account right here. Only got a couple $100. That's okay. They're going to max it out every year. And let's just say they only max it out for 20 years, not all the way to retirement. They just do it for 20 years and then they stop. Let's see what happens. So we're going to go to look at retirement year and we're going to check out what that balance is. Now, this is assuming they invested in something like the S&P 500 index. At that time, it's going to be worth almost $900,000. Okay. So remember, our healthcare costs are going to be about $400,000 per couple. That is going to increase by the time we get to that point. But if they only save for 20 years and they just invest it in a pretty normal type of ETF, like tracking the S&P 500, they're going to have $900,000 that's just there exclusively to fund their healthcare costs, and it's all tax-free if they use it for that purpose, okay? That is a massive benefit, and it eases the burden on your other assets. Because it's tax-free, you are saving money in taxes, and you are essentially reducing the strain on your other assets or cash flow to fund healthcare costs, okay? So it can make a massive difference, even though it seems like maybe not a lot. So check out if your employer, if you're eligible, right? If you're on a healthcare plan that's eligible to contribute to an HSA, check out if your employer might actually even match contributions into the HSA. Then you're getting, again, free money from your employer. So we want to take advantage of that. And then also think about saving in there and not pulling it out for little expenses here and there during these years when you have maybe stronger cash flow. Just wait, let it build, let it grow and grow and grow to the future, okay? The last little strategy I'll just throw in here is if you have medical costs, right, as we all will, between now and retirement, age whatever, whenever you decide to retire, fund those out of your cash flow, but you can hold on to the receipts, okay? The way an HSA works is you have a debit card and you can spend on that and it comes right out of your account, or you can just pay for the expense and then you basically reimburse yourself out of your HSA. And you just need the receipt to prove it in case you're audited. But you would just do a withdrawal like that and say, hey, yeah, here's my receipt. This was the cost. What you can do is you can hold on to your receipts. Okay. If you're extremely disciplined, you can hold on to your healthcare receipts, take a snapshot, save them somewhere, track your healthcare costs in these years and understand what you're paying. When you get and leave your money in the HSA to grow, right? Fund it out of current cash flow. In the future, you can always reimburse yourself out of your HSA that has now grown big, right? Because it's had time to be invested and grown large. So if you've got $20,000 worth of healthcare expenses over the next 30 years that you've saved your receipts or whatever, right? You have it accounted for. When you get to retirement, you can just reimburse yourself for that $20,000 for those costs. You get the $20,000 tax-free and, do whatever you want with that. Go on a nice vacation, do whatever you want. Okay. You're reimbursing yourself. You're just doing it, a couple decades later after your account has had a chance to grow. So little hack in there for HSAs if you're disciplined and can hang on to those receipts and track your expenses there. So that's all about healthcare and retirement. We'll talk a little bit more in the insurance module, but I want to give you kind of a primer and help you understand what that looks like and how to prepare for it. All right. We'll see you guys in the next video.
A solid retirement plan accounts for healthcare costs.